Hi everyone, welcome to this month's Financial Markets Update. I'm Piers, Bolger, the Chief Investment Officer here at Viridian. Well, as we head into the back end of calendar year 2019, we've spent a number of months really looking at what our asset allocation positioning looks like into, as I said, into the fourth quarter of 2019 and how we are thinking about positioning into the early part of 2020. Financial markets have had a very solid calendar year performance. So from our perspective, it's all about where we see the risks, where we see valuations across both equity markets and bond markets, and more importantly, what opportunities do we see presenting themselves through the back end of this year into early part of next year. When we look at equity markets, as I said, performance has been very solid. Valuations from our perspective, certainly they've moved higher through the course of 2019, but we're not in the camp that valuations are extremely stretched. The earnings outlook has moderated, but we don't believe that we're looking at valuations which are extreme levels relative to that earnings outlook, particularly if we think about the first part of next year. That's for both domestic as well as global equities. So our positioning continues to be an slight overweight to equities with a preference to global over domestic equities, albeit we have moderated that slightly. The opportunity we see in global equities is probably taking a slightly more contrarian view, and we're looking very closely at emerging market equities as well as global small caps and repositioning back to neutral, hopefully into an overweight position into 2020. If the US dollar continues to push lower through the course of next year, we think that'll be positive for emerging markets, and we also think it'll be positive for global small caps. So we're thinking about that positioning in terms of our equity exposure. On the bond front, we continue to moderate that position. We think bond yields, by and large, have tracked as low as they can, save for, as I said, any sort of significant downturn in the economic outlook. We do believe that the central banks globally have probably pushed monetary policy as far as they can go. Doesn't mean that we won't see further rate cuts both domestically and globally in part, but we do believe that more will need to be done on the fiscal front. You're seeing a lot of commentary around modern monetary theory. We think ultimately that will just lead into, as I said, increased fiscal spend from government. So from our perspective, we think bond markets have probably gone as far as they have. We still like the defensive nature of bond markets. We still expect that in the advent of any equity market sell-off, bond markets will be the beneficiary. But we have moderated that position somewhat. In the other parts of the portfolios, we have been adding throughout the course of this year to our alternatives exposure, and it's been broad-based in regards to the underlying strategies, whether it be global macro, private equity, infrastructure, equity market neutral and the like. We've been quite broad in our positioning, but we do believe that alternatives continue to be a good source of alpha, but equally provide that downside risk protection in either an equity or bond market sell-off. Positioning for 2020, we continue to really look for a more diversified overall investment strategy, and we think that in the early part that's going to be particularly important. Further down the track, 2020 is going to be driven by the election cycle out of the US, and that's probably another topic for another day as we head into, as I said, the first quarter of next year. But from our point of view, as I said, it's all about taking appropriate amount of risk but trying to balance that as best we can in regards to diversification and underlying strategies that we think can best dampen any volatility across portfolios. As always, it's really important if you have any concerns to talk to your financial advisor. If we don't speak before the end of the year, wish you all the best and a happy Christmas, and we look forward to catching up in the new year. Bye for now.